Hello everyone, and welcome once again to another of our investment manager videos. Today I have the pleasure of talking to Castlebay Investment Partners, managers of possibly the best UK equity fund that you've never heard of, Castlebay UK Equity Fund. But first off, as ever, if you have not subscribed already, it'd be wonderful if you could. We're getting close to our magical 100 subscriber target, and to cross that line would be absolutely fantastic and a huge achievement for us. Anyway, back to today's video content. And first off, many thanks to David Ridland, manager of the Castlebay UK Equity Fund. And thank you very much for your time today, David. It's great to meet you again. So, who are Castlebay?
Oh, it's a good question, Andrew. And thanks for having me on today. Castlebay are the only active UK equity fund manager in Glasgow, or the only active manager in Glasgow, which is really interesting when you think back near the beginning of our careers. So 15, 20 years ago, Glasgow managed nearly 100 billion in sterling. And just a combination of takeovers and all the rest of it. We're the only fund, so we think of ourselves as the phoenix rising from the flames, Andrew. That's what
Fantastic.
So that's you know, it is interesting though with that. I mean, I'm from Edinburgh originally, and I always kind of thought, you know, being involved in the financial side of things, that I would either end up in Edinburgh or London, obviously the two big centres. But Glasgow's been great, and actually one of the things we talk about in terms of what makes us different at Castlebay is the structure. Our focus on retained return on equity, we can maybe come on to that a bit later. That's the key thing in terms of the investing, but the structure it's just so important. And actually being, as we would, I guess, say, far from the madding crowd has been a real help, because we don't have all that noise. You know, we've spoken before, but you know, for the viewers, that we're genuine long-term investors. So we're investing in businesses, not stock prices. And when you're doing that over multi-years, the noise can often get in the way. So that's what we're trying to do. And the structure has been so helpful. You mentioned, as a partnership, we've got 4 partners, and we all own the business, we all own the fund, etc. So you know, our interests are really aligned, genuinely aligned with our fellow investors. And all we're really looking for are like-minded people to go on this investment journey with us. That's what we've been doing for the last 6 years since we've been running the fund.
Yeah, it's certainly since I was introduced to you in the conversations that we've had, it's been really refreshing, that kind of back to basics approach, which really does, for me, differentiate you. On that, it's a very, very crowded sector that you invest into, UK equities. What would you say differentiates yourselves and your process from peers?
Yeah, so you know, that structure and where we are is one critical element. I mean, I think, you know, and also that point I was mentioning earlier, that focus on retained return on equity. What's that principle? We talk about, you know, Charlie Munger and that Charlie Munger principle. It basically says the share price follows the underlying returns that a business makes over the very long term. All that noise, short term, you know, the market can fall in and out of love with businesses, but over the long term, that's really crucial. And again, the ability to do that is, again, informed on the structure and the way that we do that. So we don't have, you know, outside agencies putting pressure on us, you know, over the months and quarters, etc. We can just only invest in the businesses in which we want to invest in, hold them for the long term, let the wonderful power of compounding actually, you know, drive that. And so when we were thinking way back to what our purpose was at the very beginning, the great thing about starting up a business, obviously it's a bit of a roller coaster, it's got its ups and downs, but you start with a clean sheet of paper. And we said, you know, what's our purpose? And our purpose is really, you know, to help get financial freedom for our fellow investors. And that comes from, you know, plotting that course and sticking to it, and staying the course is so crucial. I mean, you'll have come across some amazing, you know, facts in your career, but the most amazing one I've come across, and next year I think it's a quarter of a century. I can't quite believe it. I've been doing this thing, you know, this investing business for nearly a quarter of a century. The most amazing one is the Peter Lynch phenomenon. You remember Peter Lynch, the Magellan fund manager at Fidelity? A fantastic, you know, from 77 through to 1990, he had a 29% annual annualized compound return
Wow.
for his shareholders. It was incredible. But the most amazing fact that I've come across is that his average investor actually lost money. And you kind of think, how on earth, if you'd had £10,000, that would have been worth over £250,000 by the end of that 13-year period. How can your average investor lose money? And it's just because of human psychology.
Yeah.
You know, they would wait till they had a great run, buy in, and then when things didn't go quite so well, they'd sell out and they'd keep locking in these losses. So you need to have a strategy that stays the course. And as I say, that structure, the focus on that compounding, that retained return on equity that we were talking about, all feeds into that. And that's all we've been trying to do as well. And find the people that are like-minded, that aren't like Peter Lynch's average investor.
Yeah, and let's be perfectly honest, your past performance has been very, very consistent. It is very different to a lot of your peers as well. Moving on to current market conditions, what are your current views of where we are? There's obviously so many things going on at this moment in time. We've got Brexit, or is Brexit over? Has it started yet? Who knows? The pandemic, rising bond yields, potential inflation. It's a fascinating time. And are there any positions that you'd like to highlight?
Yeah, I mean, that is a really good question, Andrew, because, you know, one of the things I think you find it in an investment career is you find out, first of all, what you're not good at, and then obviously what you think you're good at kind of tends to emerge from again the sort of the ashes of all the things that you do wrong. So we don't think we can market time. Mm-hmm. We don't think we can gaze into our crystal ball. Mm-hmm. We are quality value investors in that order. So we want to buy high quality businesses. You were talking about, you know, the sort of consistency of performance. I think that's down to, and particularly last year with COVID, resilience. That's a kind of watchword of our businesses. Mm-hmm. They're generally doing something different. Mm-hmm. And that allows them to maintain those returns, and they generally have more levers to pull as well. I mean, I can think coming into COVID, nearly half of our 27 businesses that we own had net cash. You know, they had cash on the balance sheet. Yeah. So when something completely, you know, from left field like COVID came along, it meant they had that agility to adapt. Yeah. You know, I think of IHG as a really good example. Mm-hmm. Obviously, the hotels sector was, you know, decimated by COVID. They took out $2 billion of funding, but, you know, 6 months later, when they were reporting, they hadn't tapped into that, and that shows a flexibility of a business model that's been changed over the years when they've sold off their assets and driven the franchise business model. That's given them a lot more flexibility of the cost base, and it's allowed them to get through, as I say, this unexpected crisis. Mm-hmm, mm-hmm. So we don't have any. We just try and invest in good quality businesses. Yeah. Don't overpay for the privilege, and then hold them for the long term, and let the compounding principles, you know, benefit our fellow shareholders. And so that tends to push against making a short-term strategic decision because we think or we anticipate something's going to happen. I mean, if the last 4 or 5 years have taught us anything, with Brexit, with, you know, Trump when he got in as president, etc. If you had that crystal ball, and our crystal ball is as sort of misty as everyone else's, but if you had a clear crystal ball and knew the future, you would probably have positioned yourself in exactly the wrong way, you know, as things turned out. So first of all, you've got to try and guess what's happening, and then you've got to try and second guess what the market's going to react to that. Yeah. That is all out with our sphere of competence. So we just prefer on, you know, trying to stick to our knitting, find good quality businesses. The quality value is has come out of my mistakes in the past, because when I used to put V before the Q, right? So you'd find all the cheap businesses and then say, well, which of them are high enough quality for us to invest in? But, you know, being a bear of simple mind, eventually the penny dropped, and I thought, well, what if we invert that and focus on the high quality businesses, and we do that through our investment universe? Mm-hmm. It kind of saves me from my own mistakes. Yeah. And as I say, it gives these businesses generally a bit more resilience. And then the last bit is just make sure we don't overpay for that privilege of owning businesses, which at the moment are earning pretty much twice the return of the market in general.
Yeah, and I think from all the conversations that we've had over the last few months, it's that inversion. It's the quality first, and then the value that is the real driver. And and has enabled you to, really cut your universe down to, some may say the best of breed, or certainly the names that have the best chance of delivering excess returns. David,
and we know, Andrew, we know that we're going to miss businesses. We're going to miss companies because of that, but we're entirely comfortable with that.
Yeah.
Because, as I say, it's all about, don't lose money. It's Buffett's rule number one, and rule number two, don't forget rule number one. So, again, these businesses, we've got to be confident that if the market is voting against our quality businesses in the short term, we've got to be confident that we can walk calmly the other way. I mean, isn't investing a weird thing? When the sale is on, people run for the door. Well, we want a strategy where we can walk in calmly to that shop and pick up bargains. But I think you can only do that, or we can only do that from our kind of investment philosophy, if we know the things we're buying more of are high enough quality to get through whatever the short-term issues are.
Again, for me, it makes sense. For me, it seems like it delivers that kind of safe pair of hands approach that a lot of investors are looking for, and the numbers, let's be perfectly honest, allude to that. So let's hope that it continues. I'm sure that will. David, it's been an absolute pleasure talking to you today. You take care, and I'm sure we'll catch up soon.
Thanks for having me on. Cheers now.